And when you do it with something so tangible like a property, people can see that straight away and they can say, well, yeah, obviously I'll do that. But you go behind the curtains of a business, and you see that they don't have a data room, meaning they don't have a simple Dropbox folder with their latest financials, or they don't have basic systems and processes in place.
Tradies and contractors making over $50,000 a month in revenue. I will guarantee you 30 qualified leads in the space of 90 days, or it is free. You heard that right. It's 30 qualified leads in the space of 90 days, or it's free. And you're probably sitting here thinking, what the heck? That's a 10x result on what I'm currently getting from my marketing. And that's the point. We have finally cracked the code. We've got this amazing new process. It is working, and we are absolutely rolling this out big time. Head across to tradie.wiki/offer. That's tradie.wiki/offer. Fill in the form, book a time to have a chat, and we look forward to helping you grow. Ciao. James, welcome to the Siteshed podcast.
Thanks so much for having me. Really excited
Mate,
to be here.
early bird gets the worm. 5:30 a.m. London time.
That's it. Yeah, I'm over in London at the moment, and yeah, had to get up early to be here, but yeah, excited to have a chat.
Well, that thick Bondi accent of yours, I could tell you're either from Bondi or London.
No one even asks how I am when I see old friends when I come back to London. They just sit there and laugh at my accent now.
Oh, really? They think it's a mash?
Yeah, they just can't
Yeah.
get over it. But
It's like a lose-lose, isn't it? My wife's from Canada, and when all of her Canadian friends think she sounds Australian, all of her Australian friends think she sounds Canadian. So she's sort of
yeah,
just stuck in lingo for
stuck in the
eternity.
middle. I know. I think my wife has started to adopt something similar. So yeah, you can't win.
So, mate, we're here today to talk about what investors typically look for when acquiring trade businesses. Um, now, the reason that I'm interested in this conversation is because there seems to be more and more emerging trends of trade businesses, home service businesses, construction businesses getting acquired, whether that's through like private equity firms or angel investment or just other businesses bolting on businesses as like an growth by acquisition model. So I think it's pretty relevant to all the listeners and viewers out there, so they can get a bit of context as to I suppose from the other side of the fence what guys like you look for when they are looking at investing into or purchasing businesses.
Yeah, I mean, look, it's a huge topic, right? And it's one of those things that back in my startup days, everyone always said, build a business from day one with the sale in mind. Who are you going to
Mm.
sell it to? How do you structure it for sale from day one? And unfortunately, when you look in the trade space, especially when it's a roofing, plumbing, HVAC company that's 25 years old, they probably didn't have that advice back then, or maybe they didn't even start the business with the sale in mind anyway. You hear of these amazing stories of, a guy with a bag of tools and a truck, and before you know it, he's got a, $5 million revenue business that's profitable, wants to retire, and then thinks, okay, what do I do about, selling it? And then stumbles across a couple of issues they may encounter because of the way that the whole business came about in the first place. But it's not to say that these things can't be resolved. It's just it's very different when you set up a business from day one with the intention to sell it versus setting up a business to obviously go out there and make an honest living. So yeah.
I mean, it's kind of the dream of any business, I suppose. In order to be able to have something that one day could be bought by someone. So, all the hard work and blood, sweat, and tears you put into building this business over the years doesn't essentially just get shut down. I think the reality is probably far from the truth in respect that most businesses probably just end up shutting down once the director retires or whatever it might
Yeah.
be.
I mean, to be honest, though, you've touched on a couple of points there. The reason why, I do what I do. So, we invest in and buy businesses. And the reason we do that is because, being honest, starting a business is bloody hard. It's hard
Mm.
work, for those guys that have got, past 5 million in revenue, and to be honest, the ones that get past 10 million in revenue, there's a reason why they got there, and it's because they've obviously done something right. It's hard. I think anyone out there listening to this knows that. I've started multiple businesses in different industries, and none of it's easy. So
Mm.
that's the first thing. And secondly, we're obviously looking at a generation now with the influx of businesses that are hitting the market from the baby boomer generation, which are obviously wanting to retire. And the natural thing is to say, well, where's the succession plan? And the biggest thing we see is that the younger generation, whether that's their kids or people working within the business, maybe aren't wanting to take over a roofing or a plumbing business. And I think anyone working in the trades would probably know that.
Because they want to be TikTok stars.
They want to be TikTok stars. Yeah, everyone. Honestly, it's amazing. If I told you the businesses that we come across, especially in the trade space, where it was a couple of brothers that 30 years ago started a roofing business or a landscaping business, and they're doing 2 million of EBIT, 2 million of net profits, and they've been paying themselves 300-400 grand a year, living a really good life, and they've got an asset they can sell. And then I list off how many people I know that are in e-commerce that are struggling, or they've had this startup where they've raised money but never really got the business off the ground, or haven't been able to pay themselves a wage for 5 years whilst they're building their startup. And by the time they actually come to sell it, they own about 6%. So even when they get this, great 30 million pound sale price or $30 million sale price, the fact that they own such a little amount, yeah, it's amazing that more and more people don't want to go and own a plumbing business, if I'm honest with you.
Well, I mean, I think the secret's kind of getting out, and I know through experience, there's a lot of companies out there that are getting acquired, and I think one of the things that I've observed lately is a lot of the reason for this, acquisitions within the trades is because it's so hard to like recruit team members, because there's been such a shortage with borders being shut down, all that kind of stuff. And the fastest path to growth is growth through acquisition if it's done correctly, I should qualify. Sure. And so a lot of businesses are sort of really doubling down on that, and I'm seeing it all over the place.
Yeah, and I know your podcast, congratulations, by the way, because I don't know how long it's been going, but you've been doing this consistently for a long time, and you've had some amazing guests on. And I know a few of the guests you've had from the US, where I think they're probably a bit more heavy on the acquisition side, especially in the
Well, I mean,
trade
you say
space.
that. I know. I'm not going to name names, but plumbing company in Sydney that I know, a guy that I worked for in the past, like he's on a rapid acquisition path. Like I think in the last year, I think he bought 4 or 5 companies.
Nice, yeah.
And I know that for certain because 2 of them are clients of ours.
Right.
So like, it's happening. It's happening
It
all
is
over the
happening.
place. And I suppose the reason that I want to have this conversation was to define why is that happening and what is they looking for. I mean, I've got some insight as well, obviously, from the other side of the
For
fence, but I
sure.
want to hear it from someone who's actually out there buying. Like, what are you actually buying? Because that whole mentality, which has been around since as long as I can remember, in the space of, well, it's my business and without me, it's nothing. Typically, the answer to that is, well, you're right,
Yeah.
unless you do these things. And
Yeah.
so I suppose for the purpose of this podcast is to highlight, well, what are those things?
Yeah. Yeah. And I can give you some insights into that because let's be honest, there's a number of things that business owners, like we were touching on before, encounter when they go to sell their business because they never set it up with that in mind. But I try and simplify things as well, because it's like when you go to sell a house. Do you want to sell a house that's beautifully styled with great photos, that's advertised with a good broker, a realistic price, that's not going to sit on the market for a year? And when you do it with something so tangible like a property, people can see that straight away, and they can say, well, yeah, obviously I'll do that. But you go behind the curtains of a business, and you see that they don't have a data room, meaning, they don't have a simple Dropbox folder with their latest financials, or, they don't have basic systems and processes in place. And whilst I don't want to harp on about systems and processes too much, because I've seen the other extreme where businesses think that their valuation is dictated by having, every single process documented, which I don't think is the way to go. There's just some very simple things that business owners can do, which is just neatening things up, tidying things up, and putting the business in a position that if they were walking into it and wanted to acquire it, firstly, could they? And secondly, would they? And too many times you see it where those things are just very, very hard. And, as a buyer versus a seller mentality, I'm on the market looking for businesses, and I might be looking at 20, 30, 40 businesses all at one time. But that seller is selling one business, and they're looking for that one buyer to come along and buy it. So I think just using that mindset and saying, how can I clean things up? And that starts with having a good accountant. It starts with having good books. If someone says to you, can I get 3 years of financials? That shouldn't be something that is a struggle, but often is. And I don't know if you see that with people you work with, but for us, we see that way too often.
Yeah, I mean, we don't really play in that space, to be fair.
Sure.
But I mean, I imagine it's probably. I mean, I think today with um, the presence of cloud bookkeeping software
Yeah.
programs like Xero and MYOB and
Yeah.
QuickBooks in the States, and like I feel like it's becoming less and less an issue.
Yeah.
But I mean, you're probably right. I mean, even those programs, they're kind of as good as the information you put into them at the end of the day. So
Yeah.
yeah, having a good bookkeeper that can keep all those books in order, I suppose, is something that would be save a lot of grief. Well, I mean, look, the reason you have those programs in place is to save a lot of grief throughout the year with things like BAS returns and tax things like that. So it shouldn't really be that big a deal.
It really shouldn't. And to be honest, when we look at a business and you find that they've got like 3 admin staff and a full-time bookkeeper, and then you see the accounts and you're like, wow, this thing's an absolute mess. And it's like, well,
Right.
get yourself on a cloud bookkeeping software, do some very basic training, and it's really, really simple to get those things,
I do want to
sorted.
either at whatever time in this conversation you define, but I do want to circle back to what you were saying before about the systems side of a business and how
Mm,
that's not something that you typically look well. Anyway, whatever you were saying before about how you can over systemize a business, I'm keen to hear
yeah.
what you talk about that, because a lot of the guys out there are frantically systemizing businesses. So at
Yeah.
whatever
I
point
mean,
you want to go back to that, let me know.
yeah, no, I can. Look, I think, look, when you go into a business, obviously as a new business owner, whether it's someone who's got experience, which I don't, in the trades industry. Like I'm looking for trades businesses to buy, but I'm never going to go in and work, in the business. And so it's obviously different depending on the size of your business, but I just think people can over systemize. They can just say, well, I'm going to write down every single process. So if someone comes in, they know how to make a cup of tea in the office, right? And it's like, well, you don't need to go to those degrees. It should be the critical processes within the business is where I would focus. And
Mm-hmm.
you've probably done enough to move on to the next thing. And
Yeah.
let's understand that value is what people are buying, right? They buy usually a multiple of earnings. So when you find that someone's paid a consultant to come in and help them write all these processes up, and you're like, well, has it moved the needle? Like, has doing any of this stuff, this work, moved the needle in any way, shape, or form? And often it hasn't. So I
I
always,
suppose on the flip side of that, though, maybe the
mm,
perspective that you don't get exposure to, which I do, is the fact that the implementation and creation of some of those procedures and systems and whatever are there to like in the instance of an acquisition becoming a possibility, the owner doesn't want to become part of that acquisition. They're like,
sure,
well, I'm not actually part of this business. I don't need to be here. You don't need to acquire me with it because I'm trying to get out of it. So
yeah.
here, you know.
Yes. Yeah. And to be honest, I think you're right that, and that comes down to the other thing that, well, one of the main things we look for is how involved the owner is in the first place, right? Because you've obviously, buying a business is all about risk. So it's all about determining, well, how is that risk assessed by a potential buyer? And largely in these kind of businesses, it falls on how involved the owner is. But I suppose where I'm getting at is just the critical processes. would be dictated by, you know, what the owner is doing, what the key members of staff are doing. But it's just understanding that there's a level to it, and I just think people can go a little bit too far, and it's about just making sure you're doing the right amount and not, you know, not just taking it to the nth degree.
I mean, there's absolutely no question that you can over-systemize. And to be honest, I feel like we've kind of become guilty of that ourselves in the business. Like we just have so many processes on different things, and it's almost like, you know, process paralysis.
Yeah,
It's kind of getting to the point now where it's like team members they're not even thinking about stuff. It's like, oh, well, there's no SOP on it. I'm like, well, how about you just use your brain and think about it for 5 seconds, you know? And so,
for sure.
yeah, I think
And too many times as well that the SOPs are written, but these things are supposed to be dynamic and they're supposed to be used and referenced. And too many times people go, right, I've written these SOPs. They stick them in a Dropbox folder, never get looked at, and then by the time they sell the business, everything's all different anyway. So then they've got to go back and rewrite them, and so it's making sure that you're doing something that actually, you know, fits your business, and you know, just use a little bit of common sense, I think.
I think often too like in the instance of an acquisition, well, if it's a business that's buying a business to add on to theirs, the systems probably become less relevant, because in most instances, the business is buying the trading name, they're buying the database, they're buying the goodwill, they're probably not even buying the assets. They're just basically buying the business that they can plug into their own system to deliver a different result, or a better result, which, I mean, quite honestly, most trade businesses don't have any systems in place in relation to, well, you know, what's our customer follow-up nurturing sequence, our sales acquisition process. Like half that shit doesn't even exist. So when a business that does have it comes along, goes, well, we're just going to plug all your assets into our system and watch it go. And that's typically what happens. It just goes because it's gone from nothing to something, you know?
Yeah, for sure. And I think the focus really is it's more on technology than it is on, you know, documenting every system, because you can document it, but it's not really going to change much. Whereas I think in this space, there's a lot of technologies out there that can actually, like you're saying, with you know, nurture series through email or follow-up sequences or review requests and things like that. You know, hopefully documenting your processes helps you realize where your holes are and where you can fill those gaps. And those are the gaps where I actually think that you can either increase profitability, you know, which will have an impact on the value of your business a lot bigger.
I mean, definitely, I would say to you guys, like, I mean, we've had this conversation on the show a billion times, but like a useful way to get started with processes and SOPs and that kind of stuff is to figure out what part of your business, like maybe it's the sales process, maybe you're a plumber and you do hot water heaters or whatever, and just jot out the different stages in a flow chart, and then go, okay, well, which of these stages actually needs further instruction? It's not going to be driving to site. It's not going to be just dumb shit, right? It's important stuff. It's like the technical things that will need specific processes, and it might be, you know, the completion checklist to make sure that everything's being done. Like that kind of stuff needs process. But
100%.
It's not every step of the flow that actually needs it.
No, and then it also comes down to onboarding. You know, when you onboard a new, either a new client or onboarding a new employee, it's like, how are those processes actually embedded into the workflow? Because, you know, too many times I've seen it. They've got all the processes documented. They onboard a new employee. The employee doesn't do anything, you know, and it's like we've just wasted our time. So it's just making sure that it's dynamic and it's actually part of the business. So, we've seen all you know, ends of the spectrum with it, but I think something you've touched on before is which is, you know, probably as important, if not more, is the org chart. And that's just, you know, when you're trying to sell a business, is making sure that, you know, if the owner wants to retire or the owner wants out, it's making sure that you've kind of set that up at least a few years prior. And you've probably seen that firsthand, where that they are involved. And I think we touched on this before, where, you know, the Michael Gerber story, which is obviously all about, you know, the technician versus the business owner. And, you know, too many times in the trades, they start as a technician, they develop into a business owner. and everyone's got different opinions on where that sits. But yeah, I don't know what your thoughts are, but I've always thought that, we're looking at buying businesses and not being involved in them. And if we can do that, why can't these existing business owners, right? They can own a business without operating the business.
Well, yeah, I mean, I would say if it's a business that doesn't require the owner to be there, which, and this is, you know, what's that saying? Build a business so that it can be acquired, regardless of whether or not you actually want it to be. Like, just,
Yeah,
gradually, the more you are removed as the owner from the running of the business, the
yeah.
easier it might be for someone like you to come along and buy it, regardless of whether or not it ever wants to be sold. The point is, it sold at one point. The point is, at one point, it can be, because it's
For sure. And I think in the trades business especially is, you bring on apprentices and it's like, well, could that apprentice in 15 years time buy my business? Like, if not, why not? And why are we not training these people up to one day buy me out? And maybe they buy you out over a 3-year period, over a 4-year period. But I see that when you look at the numbers of baby boomers retiring, there is demand and supply comes into it, and that impacts valuation, right? When there's 100 businesses for sale and 3 people buying, obviously that's quite a drastic example, but
mm.
valuations will take a hit. And I know that if I was in this space, as a business owner in the trade space, I would try and see how I could, have a number two to potentially take over from what I'm doing. And
So, what's
yeah,
the typical like numerical value on a business? Like, what can you more often expect as a fair market valuation price for a trade business that's selling? Like, is it normally 3 or 4 times annual profit or something like that?
yeah. So it's obviously always tricky because there's a lot of variables.
Sure.
It's not as easy as looking at a 3-bed semi and saying, in this area, what do they sell for? I mean,
Yeah, yeah, yeah.
different people value things differently,
Mhm.
depending on what the level of your business. So effectively, your multiple is a risk adjusted rate of return, really. So um, that's what you apply to a business. So the larger the size of the business, the larger the EBIT, the less risk that you'll have. So buying a company doing 500,000 dollars of profit a year, will be a much higher risk, because obviously it's probably more dependent on a business owner than it would be, a $15 million EBIT business, because they've got structures and levels of management within that business. It's not dependent on any 1, 2, or 3 people, most likely. And that, they've got the tolerances that a drop in 10% of revenue, at the point of new ownership coming in. If that were to be the case, they could weather that storm quite easily. So that's why it's hard. It's hard to give a number, but yeah, it's a multiple of EBIT, or EBITDA, especially, and yes, anywhere between 2 and 4 is usually what the market sees.
That's profit, though, yeah.
Yeah, it's of profit, and
Because
you
this is the
know,
thing I think as well. A lot of business owners like, there's so much things people write off within a business.
yeah,
Which might be great at the time, but then come when you're looking at, okay, well, what's our actual business worth here? What's the profit left in the
yeah,
business at the end of the year? You've written all this shit off, half the stuff to build your house, and
yeah,
you look at it and you go, well, there's no profit in the business. It's not worth anything.
yeah, yeah. And look, like, most of the time it is. I think the problem is we use our accounting practices, and we use our accountant to minimize our tax,
Right.
not to maximize our profit. And when
Yeah, exactly.
and this is why you get these adjusted EBITDA, which is the famous phrase from most brokers. And I'm not here to badmouth brokers. There's obviously the good, the bad, and the ugly with any people in any industry. But um, we sometimes laugh at these adjusted EBITDA numbers, because they're adding back every possible cost. But at the end of the day, you as a business owner, you're coming in and buying that business. You need to work out what the realistic profits and more importantly, cash flow of that business are likely to be. So yeah, regardless of how you paint the figures to us, we obviously rewrite those using our
Due
assumptions
diligence.
for and due diligence to what it's actually going to end up being. So
what are the actual what are the things we're looking for here? Like you guys are actually looking for? Like what are the when you go to
yeah,
buy a business, what are the things that you're actually looking for to make that valuable? What are the factors? What are the
yeah. Look,
considerations?
we can obviously talk about earnings and net profit because that is the number one thing. And when you start realizing your business is being sold on a multiple of that, everything that you can do to increase that, just multiply it in your head. You're like, well, if I can increase my profit by 100 grand, well, when I come to sell that business, that could be another 300 grand, right? So once you get that multiplier mindset on, it makes you want to kind of reduce costs wherever possible, to a certain extent, and also increase your revenues, which obviously drives your profitability. But the main things really, other than the numbers, is is firstly looking at the structure. So we will look at the structure of the business. We personally try to buy the shares of the business. We find it easier, especially when there's big customer contracts involved. But it's making sure that you haven't got personal property and other things wound up in your business structure. But once you've done that, to be honest, it's a mistake and it's very hard to unwind. But the main things we're really
Are you
looking
talking
at.
about tax structure? Are you?
Well, when people set these things up in like family trusts, and family trusts can't be bought and sold. If you set it up in a
Right.
unit trust, they can be. You set it up in a PTY Ltd, you can be. We looked at a business that we were trying to buy. It was only a small, I think it was about $4.5 million roofing business, but they had a farm that they'd bought and stuck inside the same entity. And our model is we leverage a little bit of the balance sheet to insert debt into the company, to raise a bit of money to be able to buy, to be able to get to the valuation that the seller may want. And it's very hard to do that in a brand new entity. But if you're buying the existing entity with the track record and the history and the profits, it's a lot easier to go to a financier and raise money off the back of that. So that's why we follow the model that we do. And too many times we see those errors, and it's usually from bad accounting advice from day one.
Sure.
But yeah, apart from that, the main real things is, we want to see a business that's growing. Year-on-year growth is important.
And growth in what regard?
Usually revenue and profit.
So
Revenue,
not debt?
no. No, and that was the next thing to come on to is your net assets and making sure that they obviously we expect some HP or some loans for trucks or whatever it happens to be, but not not debt that's just been brought on because they've struggled, or that's the money that's keeping the business afloat. So given that we follow a leverage buyout model, so we leverage the assets in the balance sheet, we have to avoid businesses that have already got too much debt, because obviously there's nothing there, nothing there for us to be able to either leverage against, or we can't insert any more debt into the business because it's obviously too highly leveraged to start with.
What about cash?
Yeah, cash is an interesting one. When you value a business, when we're buying the shares, we're adding a little bit in for net assets onto the top of the valuation. In the UK, for instance, when you buy a business, there's tax advantages to the seller of paying out, so increasing the valuation by including the excess cash within the business and paying that out. So then they obviously can pay dividends tax on it, and not taking it out in other less tax effective ways. Less so in Australia, but it still also has an impact, and that's why I always advise people is to get an accountant who understands a little bit on selling businesses, which not all of them do, because it's not the sale price that matters, it's the amount of money that you get back in the bank. And we've seen it before where sell your business for a couple of $1 million, but because you were not set up in a tax efficient way, you could have sold it for a lot less, but with the right advice, got more in your bank account, and that's what matters, right? Because if you're retiring, that's what you're retiring on.
What about goodwill?
Yeah, look, goodwill is just I suppose that's the difference that between the asset value and the sale price. So goodwill is what is the intangible assets of the business. So that's your name, your brand, or your IP,
So
things
how do
like
you
that.
quantify and calculate that?
Effectively, the calculation is there in itself. Is you sell the business for $5 million and you had $1 million of assets. The goodwill and IP is $4 million. And once again, that has tax implications as well. But there's not a whole lot you can do about that. But obviously, the value of the goodwill is dictated by the earnings. So if you can get a business doing 3 million of profit off of an asset base of 500 grand, or you can do $10 million worth of profit off of the same asset base, you've built up more goodwill.
So what about, you know, perhaps not so much relevant to you guys, but, for businesses that are acquiring businesses
Yeah,
as an addition to their own,
yeah,
how do you quantify the potential revenue advantage to that? For example, if I go and buy, I'm a plumbing company and I
yeah,
go, and I go and buy a similar size electrical company, and I know overnight I could pretty much 10x the income from the business based on plugging them into our system,
yeah,
and the other business knows that.
yeah.
I mean, that must. I mean, I've read so many books for those situations where people are saying, "Well, no, we knew our value, and we knew what our value was to the other business, so we
Sure.
stuck to our guns."
Yeah, look, I think it usually happens at the bigger the scale.
Yeah, sure.
It happens like that, and to be honest, that's the role that we play, right? So our role is that we buy, build, and sell. That's the model we follow. So
Yeah.
we're trying to build in Australia a 150 million um, portfolio of trades businesses, and that's exactly what we would do. But when people look to sell something like that, everyone has this dream. Oh, we're IPO, or which is obviously listing your
Mm.
business, which people seriously don't seem to understand, because it's not a great place. Especially for an owner that wants to exit, because when you do that, no one's going to give a business tons of money to and see the main person running it walk away. It doesn't work like
Mm.
that. And then the other thing that they say is, oh, we'll sell to private equity. But to be honest, the person that's going to give you the most money for the business is the one that's going to find the most synergies in you. And and that's what we're trying to do, is effectively sell to a trade buyer that can come along and say, well, yeah, if we bought these guys, we could literally plug it into our business. And selling to somebody who's bigger is what we talk about with EBITDA arbitrage. The bigger the business, the higher the multiple. So, having five $1 million EBIT companies, those $1 million EBIT companies may sell for, 3 times. But when you've got a $5 million EBIT company, it might sell for 4 to 6 times. So, bolting these companies together can have a positive effect.
I've seen a lot of operators these days who will go around and buy businesses and merge them together to
Yeah,
form a larger revenue business that is more appealing to private equity, things like
yeah,
that. And they're,
yeah,
I mean, I don't know if it's bullshit or not, but they've been talking, numbers
yeah,
up in the 10x, 15x, like that kind of thing at scale.
yeah. Look, I don't know if 10x is a number I would probably agree with. I mean,
Mm.
there's definitely usually find people like that are trying to sell you a course or a method on how to go and implement it or do it. But
Yeah, yeah,
no, I think when you look at mergers and acquisitions in the big corporate space, especially, the biggest failure is merging companies. Um, People usually oversimplify how hard it is to merge two companies, two cultures, and then overestimate how many synergies you're going to be getting out of that business. It's like, oh yeah, 30% of our customers, now know that, we're a roofing company, but now we do solar. 30% are going to now buy our solar, and you find out it's 6%, and you're like, oh crap, okay. And then you say, well, we can get rid of Sheila because we've also, got this other person, doing the books, and you try and save that 40 grand salary, but you realize Sheila was the one that was, the backbone of the culture of the office, and you piss a few people off, a few people leave, and all of a sudden the whole thing falls over. So I think people oversimplify how hard it is to merge businesses, and that's why we traditionally look after the legacy of the business owner, want to keep businesses somewhat separate. I think there's some things like back office functions that you can look to centralize, but yeah, sometimes those savings aren't really where it's at. And I think being realistic on how much cross-selling and upselling you can do across industry is also something you only ever realize once you've done it. But we're all optimists, right? So I think sometimes that clouds our judgment, but there's not to say that it can't be done. It's the space we operate in, which is obviously getting these businesses, bolting them together in some respect, and growing the bottom line.
So what does a dream trade business look like for you from an acquisition perspective?
So yeah, I know you've probably asked this a couple of times, and we keep on. I think we could talk about this for hours, but a dream trades business for us, I mean, we tend to look at north of 15 million revenue, 2 million of EBIT, but we do look at smaller businesses as well.
It's a pretty poor net profit, isn't it?
What, 2 million off of 15?
Yeah.
Yeah, I mean, look, I think it's not that we're looking for a business with 15 and 2. It's the fact that we look at over 15 million because, when you've got over 15 million of revenue, you likely have a second line of management in place. So when that owner leaves, there's probably someone there that can take over the reins. And when we look at something like 2 million EBIT, I mean, to be honest, when you look at the cost of due diligence and everything else, unless it's got a couple of million, it's probably not worth our while looking at.
Totally.
And I'll give you an example. I'm looking at one at the moment. It's a commercial air conditioning and plumbing business, but I think it's got 86% of its revenue concentrated in one customer.
Pretty exposed.
That's just a complete gamble, right? So
sure.
There are things that we can do to structure a deal, to reduce the risk. And I think sellers and brokers especially are coming around to the idea of understanding that, to sell your business, you need to understand the risk from the buyer side of things. So,
is there a ratio that you look for in regard to that in the space of exposure? I mean, I've, in the past, I've, heard if you any more than 25% of your income's coming from any one customer, then you're exposed. You should mitigate that.
Yeah, I mean, that's why 85 is just, it's, you should just go and see if they want to buy you. I mean, you're basically working just for them, right?
Exactly right. Yeah.
They should just vertically integrate and just buy you, So yeah, I think anything around that 25% is probably where you wouldn't need to structure anything too much, to reduce your risk.
So from your end, if it's like under 25%, then you're like, okay, that's not a red flag, but anything breaching 30, 35, you're like, whoa.
I mean, that's a red flag. We'll still look into it. Have they got contracts that are going to, that are expiring in the next 6 months? If it's like, we look at civil engineering businesses as well, and they have usually long-term big dollar contracts.
Okay.
So we'll look into those. In the trade space, that's probably less relevant. So, to be honest, you'd probably want it closer to 10% before you start, digging in a bit more. But yeah, customer concentration is obviously a big issue. But like I was saying before, we would probably have a deferred payment, otherwise known as seller financing, vendor financing element to it. Which we would try and pay out over a couple of years, which obviously de-risks us. Because when you're buying a business, just like buying a house, are we going to find that there's damp 3 months in? Is the roof going to cave in? How much of that did the owner know? Did they not? So I think when you've got someone who's prepared to offer those terms, they obviously understand that you know, they're selling you a good business and everything's done with good intentions. There's another thing called earnouts, which we tend to stay away from. And an earnout is effectively a deferred payment, but it's linked to performance. So if someone said, "Oh, we're going to sign this contract and it's going to deliver this," we'll say, "Well, okay, well, if it does, we will pay you X."
The
based
fucking
on that
terrible
kind of
model for someone trying to sell a business.
Yeah, it's not ideal, especially when they're trying to get out of it as well, right? But and that's something I think we've probably skipped over it, but at the simplest level is have a plan, right? So many people just they don't actually have a plan, and we've seen it recently where businesses are advertised through a broker, and it says, you know, like owner is willing to stay around for 2 weeks to hand over. You're thinking, wow, you know,
generous.
yeah, 2 weeks, yeah, generous. It's the business has been on the market for a year, but you're prepared to, you know, stick around for 2 months to ensure that it's a, you know,
I mean,
and
is that just ignorance more than anything?
I think so. But then, you know, when you work with a broker, you expect that to be educated up front, right? But too often
But I mean, brokers are another conversation, aren't
they are, and there are some good ones and there are some bad ones.
they? Do you know any good ones? Because I don't.
Yeah.
Not had a lot of good feedback from clients of ours that have used brokers in the past, but I'm sure.
No,
I'm sure there's one out there.
I think the thing with brokers is trying to understand. Like, it's like with real estate agents, right? Is, you know, you go to sell your house. You know, they all try and tell you that they're going to sell it for $1 million more than it's probably going to be sold for. But you know, in Australia, in this market, you never know. It probably will sell for more. But effectively, they're not going to lowball you because they want your business, right? It's just so obvious. But
but there's all these stupid, like, you know, monthly retainer bullshit contracts and all this crap with.
So that's what I was going to say is whenever you do business with anyone, you want to align your goals. You always want to align your goals, right? So, you know, the goal of a broker who's being paid a retainer, their goal is not to sell your business. Or if it is, it's really not priority number one. And it might be after they've had 10 months of a retainer, then they might look at it. But just align your goals. And if anything, you know, if they think that they're going to get this price that you don't think they're going to get, well, you know, you can structure it where you know, you give them, you know, something on top if they get this great number. But ultimately, too often these businesses sit on the market for too long, and don't ever sell. And some of them do, some of them don't. But that's why, coming back to the beginning, is getting organized and getting your business ready for sale is the thing to do, because there's lots of businesses out there, and you know, it's like with any house that you're selling, you want yours to be the nicest one out there, the one that people are wanting to buy.
So what can you do to make your listing stand out?
I think it's touching on the things that we're saying is, you know, a business that's got good earnings, a business that's got, you know, customers, who's got staff that have been there for, you know, 10 plus years, a low customer churn, small customer concentration. You know, the owner isn't that involved, or if they are, there's a number two that's lined up to take over their work. You know, those kind of things, you know, is the business growing year on year? Has it got a good margin? You know, and the reason why we look at margin is obviously, you know, there can be a little bit of shock or change to the business that we try to factor in. You know, can it weather a storm? You know, we've just gone through COVID. You know, we're in a high interest rate environment at the moment. We don't know what the next 12 months are going to look like, and there's different theories on that. But you know, a high margin business can weather the storm a lot better than a low margin business. So those are the main things we're looking at. And you know, a good profitable business, you know, with all those things ticked is going to sell. There's no doubt about it. It's just being able to find, you know, selling it for the right price with the right terms. And those are two variables that I think brokers are probably coming around to understanding a bit more, that, you know, if you want that price, and we always say it's your price, my terms, or my price, your terms, right? So it's funny, brokers will say, oh no, the vendor wants 100% cash up front. It's like, yeah, cool, but you know, that's probably not going to happen. And more people are trying to de-risk these deals by doing, you know, 60 to 80% up front, the rest deferred over 2 or 3 years. Firstly, that de-risks it, but you as a seller, you can negotiate for an interest rate on that as well, right? So
Mm.
what are you going to do with the money when you retire anyway? Put it in the bank and earn nothing on it? Well,
Mm.
why don't you become the bank and you can earn a healthy interest rate off of the buyer of your business anyway. So um, those are the main things. And to be honest, I'd probably say I don't know who the right professional is, but getting someone on board. Maybe it's not a broker, maybe it's a consultant who specializes in M&A, maybe it's an accountant who's done these kind of transactions, because your local accountant probably hasn't.
Mm-hmm.
But getting people on board to at least give you a third party view on your business and help you get it set up for sale.
I mean, it's just one of those things, isn't it? You've just got to have the right team around you.
Definitely, I think that's always the case with everything in business, right? Is whether that's running it, whether it's selling it, whether it's starting it. Yeah, people are undervalued, and the right people can really make the difference. So yeah, I think it's super important to do that. And you may not get the right team straight away, but don't be afraid of speaking to multiple people, getting multiple opinions, and working that out on your own, right?
And like, I suppose, lastly, just in relation to the legal side of these transactions, like you, likewise, I suppose, like you were saying, with on the financial and the accounting side of things, you want to have someone who's been there and done this. Probably goes to say the same on the legal side of things, with having a lawyer who understands business transactions, because you don't want to go and get your family lawyer to look over this, contract, which could essentially leave you skinned.
Yes. Yeah, it's an interesting one, because I also say try and find a contingent fee lawyer, because again, if you're paying a lawyer hour by hour, and we've seen this where, you get a legal bill and it's
Mm.
like 45 grand on the seller side, and you look at our bill and it's 5 grand.
Yeah.
Um, and that's because we have a contingent fee on a fixed price, and um, we advise people to do it, and sometimes they say no, I'm going to use my family lawyer, and you say okay, but I'm just warning you, this is how it's going to work. And then the hours tick by, and again, have you aligned your goals? Do they want to
Mm.
do it quickly in the shortest period of time for the least amount of money? Well, no, they don't, because you're paying them by hour, just like your broker that you're paying them a monthly retainer.
Mm-hmm.
And I think that's simple. That happens in business, right? Is just align your goals.
Yeah.
How do we both set expectations out from the start, and how do we both achieve what we're trying to do, and don't get a shock come the end of the day. And paying a lawyer hour by hour is not the way to go. So again,
Mm.
yes, find those right people, but do it in a way that aligns with your goals and your outcomes.
Awesome. Well, man, I've learned a lot. That's for sure. I think there's probably a lot more to learn as well. We've covered sort of similar topics in the past. Did a whole series on exit strategy versus wishful thinking.
Yeah.
That was a long time ago. That was with Danielle Putnam, and then we did another series on how to sell your trade business. But I just feel like these conversations they're forever evolving. Especially with the changing landscape of things like COVID, pandemics, and whatever it might be. It's sort of always things that are evolving in that space.
Yeah, it's always changing, I think. But the fundamentals of business, the fundamentals of business still apply. And
Mm-hmm.
a good profitable business that's growing year on year, that doesn't have a lot of debt, that your business will sell. I think that the issue that we find is that it's about aligning expectations, right? And
Sure.
if you go to that broker and he's like, your business is, and we see this all the time, it's going to sell for 4 times adjusted EBIT. Well, straight away I look at that and, well, what are these adjustments? And then you reduce the adjustments down to what is actually reasonable.
Mm.
And then, it's probably not 4 times. It's probably a bit less. And then the businesses sit on the market for a year, not selling, and it's just like a house, right? There's a house next
Yeah.
door to where I am at the moment, and it's been on the market for 5 years, but they've priced it probably at 800 grand more than it's worth, and it's not going to sell. Just don't be that house. And
Yeah.
I think too many times you're, when you're looking at a house, for instance, and I use this example because it's obviously so easy to see, but you don't look at what people are listing property for. And I feel like Australia at the moment with the property market is a bit of an anomaly, but you're looking at what things have sold for, not what things are listed for. Over in the UK where I am at the moment, things are selling for about 20% less than what they're listed for, because again, it's a demand and supply situation, and with high interest rates and everything else, it impacts things. And the same goes for businesses when there's more businesses on the market being sold, and there will be, because of the baby boomer generation retiring, and we will see more and more of these businesses on the market. That may impact valuations, but making sure yours is the neatest, tidiest one out there that's got the best story, and the easiest to buy. Going off all the stuff we've spoken about is probably the biggest success path to getting where you want to get to.
James, it's been great. I've got to wrap this up, but where can people get hold of you if they need to?
Yeah, look, the normal places. It's James Nathan. You can find me on obviously LinkedIn and Twitter and all those places. But I have set something up for everyone if they want to go onto it. It's james.scoreapp.com. So basically, you would go on there, answer 12 questions, takes about 60 seconds, and we send you a personalized report on how ready you are to sell your business and what you can work on to improve it. So James.
Well, I'll put I've got that right here in the notes actually. If you guys are listening to this or watching this, head across to the siteshed.com and search, just type in James Nathan or go to the podcast and you'll find this episode, and that little lead magnet there will be sitting in there waiting for you to tinker away on.
Yeah, and if anyone wants to reach out, ask further questions, or contact us, or they want to sell their business,
give us your mobile, mate.
Yeah, I will do. Phone will be inundated, right? But yeah, no, reach out. We can obviously have a chat. We're actively looking in this space anyway, so by all means, bear us in mind, and get in touch.
Beautiful, mate. Appreciate that. And if you listeners and viewers out there have got any questions, feedback, apprehensions, if you want us to expand on anything in particular that we have discussed, or anything that I might have missed, which is very likely because I don't really know what I'm talking about in relation to this stuff, just let us know in an email or in the Facebook group or wherever you see this come through. And I'm sure James will come back online at 5 a.m. UK time and answer some of those questions.
Why not? Hey, everyone loves waking up early.
All right, mate. Appreciate that. Thank you. And listeners, viewers, that's a wrap.
Thanks, guys. See ya.
I hope you enjoyed that episode of the Siteshed podcast. If you like the sound of 30 qualified proposals in the space of 90 days, I just want to recap. Head across to tradie.wiki/offer. Watch the videos, fill in the form, and make sure you book a time to have a chat with me. This is for businesses that are making $50,000 a month in revenue, are located in Australia, New Zealand, Canada, or the USA, and you're a trade business or a contractor that works with project-based work. Head across to tradie.wiki/offer. Yes, I realize it sounds too good to be true. Trust me, it works. Do it now. I look forward to chatting to you soon. Ciao.